What's up, everyone? Super Bowl Sunday. So I'll do a quick live stream. Throw out some tickers. Maybe I'll do a live DCF. Of course, if you donate, I can do a DCF, but I'm happy to do it for free. Ed, what's up? Thanks for joining. What did you guys think of yesterday's live stream? So you can see the person, Paul, who was on the stream. He didn't have that much knowledge about the market, but it doesn't matter. You learn. If you're involved in any activity, you're going to learn something. And, he knew some stuff. I'm sure some of you may know a good amount, but a lot of people feel they don't know much. So they would never do a live stream with me because they don't feel comfortable. They're like, oh, I don't know much about the market. What if I'm asked questions? It doesn't really matter. It's just really about participating. It's kind of like when you're a kid, when the coach says, just be involved, practice. Don't worry if you're the best or the worst or you're in the middle. It doesn't really matter. You just got to move forward from your starting point. That's kind of the idea. Hey, Devin, ADM. Do you think the U.S. stock market is a bubble? No, I don't think it's a bubble. I mean, there's always going to be these ups and downs, and who knows when it's going to crash. Because if I could go back 10 years, even 10 years now, and I knew how the market was going to react, I could be a trillionaire because you could time everything perfectly. You can buy options right before it blows up. But it has to go up. The U.S. economy is a very stable, strong economy. It's very versatile. And things go up in price over time. It's called inflation. So the stock market has to go up over time. There will be plenty of companies that go bankrupt. But overall, the market as a whole will increase. If you are concerned about risk, then just buy an ETF. I have a lot of money. Probably 20% of my funds are in the S&P 500 index. So I don't preach that I know it all. Hey, Savvy, and I could always make money because it was a painful time when I was losing so much money in Meta. But I stuck it out. There might be times I bought stocks that I try to stick it out and it never came back. And I just lost money. But that's just part of the game. But like the guy yesterday who was unsure about the market, I just told him just go in it, buy an index. Like nobody really knows. I don't know which companies are going to go bankrupt or which companies will trade sideways for 20 years or whatever. I mean, I have my intuition, but it's no. My average for Meta was 129. Wow, that's great. I bought Meta the very first day they started trading in 2012. I bought it for 40. Fortunately, I was buying options. It got called away. But my cost basis for Meta is I have two. I bought it twice. Well, two main buys. 2017 at 152, so you're a little better than me, and 2022 at 339. I did buy some more. I bought 9 shares in April 2022 at 224, but only 9 shares. My bulk was 320 shares in 2017 at 152. So I'm up 220% on that. So that happened to be a good one. Not every stock we're going to find is going to be a home run like Meta. Like you could have bought Intel in 2000 or 2003 or 2005, and you're still not really making much money on that stock. But maybe you bought Microsoft. Maybe you'd be killing it now. ADM. Lucky you, I didn't start investing until 2021. Yeah, it doesn't really matter when you start, because a lot of people think, oh, I missed the big run up, so I'm never going to make money. What's the point of investing? Because they feel they missed all the gains on like these big stocks. Let's see, 2.5, 2.9. Let's try to use the damn it. This is a different approach I started using. I'm going to see how it works. Fuck. Come on already. So annoying. Okay. So let's try a new approach to the DCF. So I just got to fill in these three. Okay. I started doing a different approach on my video to do a DCF, and I'm going to see how it works. Okay, free cash flow. I'll call this the free cash flow, and the old one I'll call the wait. Okay, this one I need a little more info. Can you read the number well? What is the outcome? Okay, I just had to set up my my model. Okay. Okay. Okay, I set it up. I'm no longer Meta. I sold out. Yeah, nothing wrong with selling out. Asman, what's up? Everybody has their own, and people are telling me, "Oh, you got to sell your Meta. You're up a lot." Maybe I should. I don't know, but I'm not. Okay. Actual. I'm not using the actual. Sorry, I should probably have. Free cash flow. Okay, here we go. Meta PE does not make sense. What's the NVIDIA? What's going on? God, I feel like such an idiot. I could have been a billionaire. I could have just invested in NVIDIA this whole time. God, it's 1.7 trillion. Why don't listen to people like me? Just put your money in NVIDIA. You could have been rich. Okay. So there's obviously more than one way to skin a cat. Okay. Okay. So I'm using a different approach because I saw Simply Wall Street projects future free cash flow. And as you can see, in 2025, they project 2.9 billion, but only one analyst. So if we don't have like if we didn't have future free cash flow projection, I would have to do a different approach. But I'm going to try this approach to see how it works out. I think 8.3 is a little is a low whack. Let's go with the 9.3, the higher whack, to be conservative. So it looks like it's trading at a discount. The stock price is 53. I calculate 71. Meta PE does not make sense. Never mind Nvidia. You sold Meta? No, I didn't sell Meta. Meta is kind of like Berkshire Hathaway. I'm taking that one to the grave. I'll probably hold it until 80 or whatever. I don't plan on getting rid of it. There's valuation is just one part of your business, one part of the process. Because think about it, if you owned a business, if you had a business and like your revenue in year one, let's see. I mean, if you guys watch Shark Tank, this would probably make sense, but revenue and profit. So you guys watch Shark Tank? So say you had a business and, year one, God damn it. And let's just say your margins are 20%. So year one, and you could, whatever business you want to call it, maybe you mow lawns, maybe you're a liquor store, I don't know, whatever business. So you're getting started, you don't have many customers. And then year two, you're at 80,000. And now your profit is 16. Year three, you're up to 150,000. I mean, I sold Meta, didn't make a possible 200K on options. Hard to get out over that. They are now the ultimate dividend growth stock. So if you own like a small business and these are your revenue and profits, like, and if somebody wanted to buy your business, how much would the business be worth? Well, generally a small business is worth 1 to 2 times profit, right? So the business is worth, 30 to 60K. But if you grew it if you tripled the revenue in 3 years from 50 to 150 and you tripled your profit, I mean, on paper it might be worth 30 to 60K based off of doing you could even do a DCF or whatever, but there's more to the business than just what the numbers are. There's a future. And you could see the possibility of growing and scaling and making it into a multi-million-dollar business. It's just like that with stocks. Like, just because a stock is, the company's valued at 50 billion, doesn't mean like in this stock, just because it's valued at 37 billion and the market cap's 28 billion, doesn't mean it can't be a $200 billion stock in the future. That's really the hard part. Hard to figure out, right? And it's not so much valuation. It's not so much fundamentals. It's market perception. So like with a stock like Tesla for many years and now Nvidia, the value is so much higher than their numbers, their financials. Because if you look at semiconductor companies, I was just doing a video on a semiconductor company. So I have the stats. What the hell? God damn it. Wegro, what's up? Okay, so if you look at semiconductor companies, there are 62 publicly traded semiconductor companies. Nvidia is by far the largest, 1.8 trillion market cap. But they have, in terms of revenue, they're lower than Taiwan Semiconductor. A lot lower. They're like 40% lower revenue than Taiwan Semiconductor. And in terms of free cash flow, they're lower than Broadcom. So how do you say this company is worth 1.8 trillion and these companies are worth 1/3 of that, even though these other companies are bigger? Because investors look towards the future. And if that is accurate, if Nvidia does grow to like the levels of like Google and Amazon, where they're hitting like 50, 60 billion of free cash flow and 200 billion of revenue a year, then 1.8 trillion makes sense. But right now, they're not worth 1.8 trillion, not even close. So how do you kind of figure that out, that disconnect? Well, you might not even need to figure it out, because if you're like a swing trader, if you were smarter than me to pick up Nvidia when it was like 800 billion, you could have doubled your money pretty quickly, and then you could just sell out, because if they don't hit these levels, it's going to come down. Lots of stocks blow up like this. Well, not like 1.8 trillion, but lots of stocks, their market cap blows up to like 300, 400, 500 billion, and the company just never grows to that level, and so eventually comes down. Like, it's like Tesla. I don't think Tesla is worth is $1 trillion company. Let's see. What's their market cap, Tesla? 600 billion. So they're right here, 600 billion. So it's about triple. So they hit $1 trillion market cap when they were 330, around 330. This is when they were 1 trillion, which was back at the end of 2021. And I think they peaked at like 1.3 trillion. They did come down quite a bit. They have been coming up, but they're still trading well below that $1 trillion level. So I don't think personally they're $1 trillion company, and I don't think they'll ever get the revenue and profits to be $1 trillion company. So I think this is one of those stocks that got inflated because of the market thinks the future is so bright, but once they prove that they're not hitting those levels, that's what I think. I could totally be wrong and could hit 5 trillion market cap. This is just what I think. But I feel Meta is a proven entity. And I still feel strongly it's going to hit $1,000 a share. It's going to be 2 trillion maybe this year. If not this year, I think by mid 2025, it will be 2 trillion. That's what I think. Because making cars it's just not a profitable business. It's a good business. It's a really good business because people need cars. That's a very important product. But it's very, very expensive to manufacture cars, and it's expensive to scale. You need a lot of infrastructure. You need a lot of equipment. You need a lot of space. You need a place to put those factories, and America is just really expensive to put those factories. So you might have to start going overseas to start building factories. So it's not an easy thing to do. That's why there's no the other car companies. They're not worth that much money. GM, it's been around forever, is 45 billion market cap. It's a good sized company. Ford, 50 billion, just good sized companies. They're nowhere near the 300 billion plus market cap companies. That's why Tesla is just, but we'll see. We'll see what happens. Nvidia isn't worth 100x earnings. It's not. But if it keeps going up, just ride it. Ride the trend. But just make sure you get off the ride before it crashes, because it's going to crash. Just like Tesla crashed. When it was 1.3 trillion market cap, it's 410, and then it came down to 100. So it went down 75% from that peak. It's come up, and I don't know if it'll get back up to these levels again. But that happened to Nvidia too. I remember Nvidia when it was around $1 trillion market cap, and that was at the end of 2021. And then when it came down, then I thought, this is where it's supposed to be. And then it just, like a rocket ship, it not only hit that trillion level, now it's closing in on 2 trillion. So they said that China EV industry is blowing Tesla away. They don't even consider Tesla one of the magnificent seven anymore. Yeah, it's the thing. Even with EVs are expensive. They're not easy to make. It's if it wasn't for rebates, because you do get the benefit of buying EV, or like buying solar panels for your home, or buying an electric vehicle, or doing something that's going to help the environment. The benefit of that is the government will give you a tax break. You might get a check in the mail. So without that, Tesla, they'd have no shot of being profitable without the support of the government. So it's but I felt stupid too, because my friend whom he put he put 30,000 into Tesla, I think back around here, 2018 or so, 2019. And his 30,000 went up to like 250,000. He 10x'd. I was like, you got to sell, you got to sell. And then it went up again. He was up to nearly 500,000. And I felt stupid. I was like, I'm telling him to sell. I'm the one who should have been buying. But I guess it was inevitable. It has come down. I mean, he's still up like, 1,500%. His 30K is probably like 400K. So he's still doing fine. But I mean, it's not like it's not a meme stock. I mean, it is a good company. It's not like it's a company that, I mean, look at the revenue went from 30 billion to 100 billion. So they're selling cars. They're selling something of value, and they are profitable now. So it's not a garbage company. It's not like one of these silly meme stocks, I guess, like GameStop. That it's 4.5 billion. Wasn't it like 50 billion market cap at one point? I mean, but I mean, look at them. Like their revenue is flat, 5 billion to almost 6 billion, and they have a net loss every year, so they're losing money each year. They did have some positive cash flow, but I mean, it's GCT. What's GCT? I feel like I'm losing my voice. Did anybody see the live stream yesterday? We were going through how buybacks affect the balance sheet. Because when a company buys back its own stock, what does it do with that stock? It carries on the balance sheet. But what if it reissues that stock? If it reissues a stock at a profit, the accounting is different than if it reissues a stock at a loss. And we went through that yesterday. So that's the range, 8.3 to 9.8. GCT. GigaCloud, 29.1.2. Yeah, Bezos sold a lot of his Amazon. That's killing me, Amazon. It's one of my worst performing stocks. I bought it at 112 in May 2020. So I'm finally up like 40%, but it's not much. GCT. I just did a video on ARM today. ARM Holdings, the semiconductor company. NVIDIA tried to buy ARM for $40 billion 3 years ago so they can grow their semiconductor business. But it just didn't go through. Regulatory gotten away, like the government interfered, so they wouldn't approve it. And the stock went up 50% last week. So it's 118 billion market cap. Did anybody know the different? My hair looks different. On Friday, I had a hair transplant. So they cut the back of my head, a strip of skin, the back of my head, and then they put it like into little pieces of skin, and then they placed it around my head, and they put 2,400 hairs on my head. 11 hours I was there. So you can't tell, but it's going to take like 6 months to see any difference. Wow, look at that growth. 108 million, 80 million, 100 million, 110. Okay. This is a lot quicker, this DCF. What are you guys doing for Super Bowl? We're having some friends over. I can't wait to get 40,000 subs. They say Intel is getting into the lithography game. So I'm at 37 for this stock. It's trading at 29. I guess when I started working at the hedge fund, I wasn't really making videos. So I guess that's why my growth kind of was stagnant. Because I started in May 17th, 2020. First video, 5/17/20. So it took 2 months and 1 week to hit 1,000 subs. And then I did my first portfolio reveal. Then it took 9 months and 4 days. In 9 months and 4 days, no, 7 months and 4 days, just 7 months to get to 10,000 subs. And I did my portfolio reveal at 10,000. And that was February 2021. Then it took 9 months to get to 20,000 subs. Then it took only 5 months to get to 30,000 subs. And now it's getting close to 2 years, and I'm still not at 40,000 subs. I guess I haven't been making as many videos as I used to make. It kind of gets disheartening when you're not getting as many views as you used to get. Like I used to get like average about 1,500 views per video. Now I'm like averaging like 500 a video. So it's just kind of like it. As much as you don't want to think about that stuff, it takes away from your motivation. Of course, some people who only get 10 views a video would love to get 500 views, but when you, it's like if you were at a job and you made $100,000, and then they were having problems with the company, so they cut your salary from 100,000 to 70,000. You know, maybe 10 years ago, 70,000 would have been fine. You would have been happy. But when you're at 100 and then you go down, you're just never going to be happy. But I kind of complain too much about this stuff. It's probably getting annoying. So GigaCloud, what? I'm not too familiar with GigaCloud. My friend who's coming over started the YouTube channel. He only made one video, but Giga's. Wait, this is not GigaCloud, is it? GCT. We are not in bull market. Well, there's no Wikipedia page on GigaCloud. It's funny because sometimes you invest in companies and you don't even know what they do. Like, I bet you people think they know what a company does. Like, somebody that's invested in Coca-Cola, I say, what do they sell? And then the person was like, are you an idiot? They sell Coca-Cola. And I'm like, no, they do not sell Coca-Cola. They sell syrup. And then other companies sell Coca-Cola. They just sell the syrup, which is a brilliant business model because they don't have to deal with manufacturing the product. They don't have to deal with shipping the product. They don't have to deal with returns. They just sell the syrup to all these different distributors and companies, and those are the ones who use the secret sauce, the syrup, to make the product. So GigaCloud operates a large transportation network through partnerships with shipping, trucking, and freight providers, and operates 24 warehouses globally. 24? That's a lot of warehouses. And when you ask, like, you're invested in Amazon, that's a little more complex. Amazon does a lot of things. Like, what do they do? Like, what does Amazon do? And everybody knows, oh no, they buy and sell things over on their website, or people list things and they sell it through their website and ship the product. But they're the genius of Amazon is they're the ultimate logistics company. It's hard to do what they do. They perfected the logistics model. Because anybody can put up a website. There's Craigslist. I could just go to Craigslist and list something for sale, and then when somebody contacts me, I coordinate with them, and then we sell the product to them, and they give me cash or whatever. But they have nothing to do with logistics, Craigslist. But Amazon has perfected the model where if you order something, sometimes the next day you get it. There's no waiting a week or two, and there's no talking to different parties, and like, who are you even talking to? So if you invest in a company, you should understand what they do. As sometimes it seems so obvious, but and a lot of times it's not even what you think they do is not what they do. Or what you think they do is like 5% of their business. Like Alibaba, most of their money is made from Alipay, the merchant provider, like the PayPal of Alibaba. That's where all the profit is, the transaction fees. So GigaCloud technology. Yeah, I mean, Wegro said supply chain, like making things and selling things is simple relative to building a logistics and supply chain network where things can move efficiently throughout the process and things are trackable. And then that's an amazing thing that Jeff Bezos built. Can anybody tell? You can't tell from the front, but if you look the back, you can see where the hair was implanted. I don't know if you can see, because the front, they took a strip from the back. They really literally cut a strip of skin across the back, and that's what because I remember seeing Elon Musk when he started PayPal in his 20s. You can see he was pretty much losing his hair. And now look at him in his 40s. Such a full, beautiful head of hair. Or even in this picture. Because the hair in the back of your head, for a lot of men, it's pretty full. That usually keeps growing. Like you can literally have a long ponytail in the back of your head and totally bald on top. So they take that really great hair and put it on top. But the hair, there's so much hair in the back that even if you take a strip of hair off, like you permanently remove that strip, you won't even notice because there's so much hair covering the scar. So you would never even notice it. It's expensive too. It was like $14,000 for but in Thailand, if you want to get it done, Thailand is like the hair transplant capital of the world. Like there's thousands of people every day that go to Thailand just to get their hair transplant. It's like everywhere. Every street corner, there's a doctor doing hair transplants. So GigaCloud. So what the hell is GigaCloud? This is like what Warren Buffett, when Bill Gates was trying to explain Microsoft to Warren Buffett had no clue what he was talking about, and he didn't invest in Microsoft, which is unfortunate. Bill Gates, Warren Buffett just at least wants to understand what the business does. He needs to understand at a high level in order for him to start really digging in deep and understanding how to look at the financials and look at their competitors. So I'm not nearly as good as understanding the financials as Warren Buffett, but I think we can all at least understand what a company does on a high level. like companies that's like the Teslas and the Fords, companies that sell cars are very important because everybody drives a car. And I don't know if that's going to change, maybe in 100, 200 years, maybe, but it's like everybody has a cell phone, everybody has certain things, everybody eats, everybody wears shoes. So there's certain products like that make sense. Now you have to see if that product is scalable and if the company has a good management. So let's see, strong financials. Okay, revenue in a quarter was 178 million, gross profit 48 million. So their gross margins are okay. 50 over 178. So 50 over 200. It's like, what is that, like 45% gross profit margin? So that's decent. Net margins are above 20%, so that's good. What do they? Does anybody know what they do? Like, who recommended this company? Like, what's the purpose? What do they sell exactly? Supply, fulfilled, retailing, multi-directional trade, unidirectional fulfillment. So they're a fulfillment. They have a technology platform for logistics and fulfillment. Is that the purpose? The platform runs Gig Cloud, business-to-business marketplace, integrates everything from product discovery, payment, and messaging portals, leveraging channel diversification from suppliers while resellers gain access to thousands of products. So it's a logistics kind of thing. Supply chain logistics, which is really important. I have a hard time valuing these businesses. It's not impossible, but like I like valuing a supermarket. I like valuing like a company that sells, like furniture, because I know it makes sense, because I just got to figure out how much money it costs the company to buy and make the furniture, and then how much money they sell it for. It's kind of clear to me. This stuff, it's a little more complexities, especially if you deal with companies with like patents and trademarks, because that has to be factored in, and that's really confusing how to factor in intangible assets like that. Before I lose any more viewers, anybody have any other suggestions on a company I can do a DCF on? What are the trending stocks? Alphabet, Intel, 22nd Century Corp, tobacco company. Have you ever looked at ADM? We just did ADM like 5 minutes ago. That was the first thing we did. AEP-EDU. EDU. Yeah. it's a Chinese company. Commodities are hard to value also. EDU is a good one. Let's do EDU. Commodities, it's very dependent on the price of the commodity, and it's very dependent on 7.8 to 8.8. In steel industries. EDU. New Oriental Education and Technology Group. 14.688. They're in Beijing. I hope they do US dollars. I'm on like Vicodin and other drugs because my head is really tight. The skin's real tight in the back. It kind of hurts when you sleep. Where they put the scar in. So 1.1, 775 up to 1.1. That's a nice 1.15. Okay. It's a Chinese company, so I did lower the WACC. I mean, raise the WACC, and I lowered the terminal value to just compensate for the to speed up the process. $775, $846. $1.154. Okay. Okay. F. G4 over G5. Come on. What's the terminal value? E11. Okay. How about that? Ticker EDU. Okay. The hell? Damn it. Okay. Just wasting a lot of time. Okay. Organizing this file. Why does it do that? It's so weird. I don't see how. Okay. Okay. Still doesn't seem that clean. Okay. I guess that's good. I don't know. Yeah, Algonquin, that's a popular one. I haven't gotten around to that. Maybe I'll do that soon. Okay, here we go. Here we go. Ticker. What the fuck? Oh, it's that one. Oh, it's this. Okay. That was the biggest waste of time. Okay. So what we were doing EDU. Come on. So EDU 7.8 to 8.8. That's the whack range. I got it at the highest end of the range. Terminal, let's put the terminal at 2. I mean, it is a Chinese company, so let's keep it at 1. And these are the future free cash flow estimates. So estimate year 1, year 2, and then a terminal value. Come on. Does anybody know what I'm doing? Does this helpful seeing me do this, or is this just a lot of like a waste of time and there's no like whack? If you want to know like how I get the formulas and all that stuff, you know, I'm happy to show you. Okay, here we go. donate. What the hell? Okay, so we got it. So the free cash flow projection, the way we did it, can you explain how you get your formula? Yeah, give me 1 minute. I'll be right back.
Oh, can you use my bathroom? I hope I don't need to get another avocado.
Okay. So it's the same approach as present valuing anything. When you want to present value, like the future payments of a bond, what it's worth today. Like if your friend wanted $100 from you, like today, he said, "Can I have $100? I need it for something, whatever it is." And then he said, "But I can't pay you back for 1 year." So in 1 year, if he gave you $100, it's probably not the best investment for you because you're losing money. Like, but how much do you lose? And then so you say to your friend, "Well, I don't want to do that because if I give you 100 today, and then 1 year from now you give me 100 back, I should get a little more than 100 because today $100 I can buy X amount of stuff, but next year I won't be able to buy nearly as much as I could this year." And to make it even a step further, if your friend said, "Can I have $100 today, and I'll give you in 10 years $100," then it'd be like an obvious, like, no way, because in 10 years, like right now, $100, like that's like I could fill up my car twice. It's about $50 to fill up my car twice. But in 10 years, it might be only once I could fill up my car because things go up in value. So how do you figure out how much money your friend will give you in 10 years. I mean, you could take a simple approach and just say, well, I mean, inflation's roughly 3%. So you have to pay me back 100 plus 3%. And so you would say to your friend, well, okay, I'll do 100 times 3%. So you'd say to your friend, okay, so if I give you 100 today, you have to give me $103 next year. At least it's kind of even, because inflation is 3%. I tell him, hell no, you still owe me from last time. Of course, there's a lot more involved than this. What if your friend said, I'm going to pay you back in 2 years? So then it's a little more complicated. So it's like, how much, if inflation is 3% a year, then what's the obvious answer? Like, if your friend wants $100 today and he will not pay you back until 2 years, how much money do you think he should give you in 2 years? Does anybody know? Like, roughly. Like, you don't have to give an exact number, because we obviously know 1 year it's 103, so it's going to be more than 103. Do you have any guesses like what it might be in 2 years? We're just using the 3% inflation. You know, don't read into it. I know we can read into it and get pretty deep with this, but just to simplify it, we'll get deep in a little bit. But based on, you just want your friend to pay you back inflation so you don't lose money. How much would your friend give you in 2 years? Would it be like 106? That would be the obvious. So it'd be $3 a year, because every year it's $3, right? So 1 year, so times 0, time 1. Funds. I always go through these long drawn exercises and I think I lose people, but I guess I'll still do it anyway. Okay. So at time 0, this is how much money, this is how much money you have from this transaction. So in time 0, you're at $100 because you give your friend $100. So you have negative 100. In 1 year, if you tell your friend, if you pay me back in 1 year, exactly 1 year from today, you can just give me 100 plus 100 times 3%. Okay, I made it a negative, so I had to fix that. So you say to your friend, I'll give you 100 today. If you will pay me back in 1 year, you give me 103. and this is a good exercise for me because I don't explain this every day. So, okay. But you tell your friend, you don't have to pay me back in 1 year. If you can't, you don't have the money, you can wait another year. And then if you wait another year, in deep sleep scenario, you would just be adding $3 each year. So it would just be plus 3. In year 3, like you tell your friend, you don't have to pay me back even in 2 years. If you can't, just in year 3, you give me 109. And you kind of follow this pattern. You say you can pay back anytime you want. It just keeps adding 3 a year, which sounds logical, but it doesn't work out that way. It's not you'll be losing money. You guys figured it out. James Sketcher and Richie figured it out. So the real-time value of money, assuming we use this 3% as a discount rate, we might use a different discount rate, but we're going to use 3%. It would be the let me just do the one. I guess I can do with. I want to keep these here in case I change it. 100. What the fuck happened? Okay. Okay. So you don't multiply it by, because in the original scenario we did 100. We did 100 plus 100 times 3%, because 100 times 3% is 3. So 100 plus 3 is 103. But you have to actually raise it. You have to do 100. That's this J8 right here, plus 100 times 3 to the first power, because it's 1 year. J12. What? I think it'll be easy if I just put 100 here, because then I don't have to put these minuses. It's screwing up my formula. Yeah, that's how you get the terminal value. So 100. J12. Damn it. So what am I doing wrong? Do you guys think they're going to cut rates this year? Okay, that's what I did wrong. Okay. 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 Okay, I got the formula right. So let's bring out cents, because you can't tell. It'll be more obvious later on. So the correct way to do it is you have to compound the money, because if your friend didn't pay you back after 1 year, like he didn't give you $103, right? Then you have to get a 3% return on that 103. Where in the first example, we just did a 3% return on 100. So we just assumed it would grow $3 a year. But after 1 year, you would have $103. So you have to get a 3% return on 103. So you would have actually $106.09 at year 2, not 106. And then year 3, 109.27. So you should get 27 cents more. And it doesn't seem like a big deal. Because it's only like, what, 27 cents. But when it goes out far enough, and especially if interest rates are high enough, it becomes significant. So let's say your friend couldn't pay you back for 29 years. So if you did the $3 a year thing, you said either $100 today or $187 in 29 years. But if you compounded it, it would actually be quite different. it would be 235, which is a pretty big difference. So even though it's a 3%, that's a 26% difference on your return. And could you imagine if it went up further? Your grandchild would have to collect the money. So in 91 years, the difference is $370 and nearly $1,500. So that's the beauty of compounding, which probably confused you even more on this particular situation, which I seem to do a lot. But I still have 13 viewers, so I guess people haven't left. Compounding is a beautiful thing. And you could find these formulas on any website. Just go to how to present value, future cash flows. But so what I did for this particular company, EDU, so I went to Simply Wall Street and I saw this is their free cash flow forecast for the future. So 2024, the free cash flow is projected to be $775 million, then $846 million, then $1.1 billion. So I plugged that in to my future free cash flows for the next 3 years, those three amounts. And the discount rate, all this stuff is estimation. I mean, it's what side of the bed did I wake up on tonight? Which whack would I use? Maybe one morning it's 7.8, but that's a different story. So I get the discount rate from Finbox. It's free. So you just go type in EDU. You can type in any ticker, and then I go to the models. Then I go to the cost of capital, and then it gives me the discount, the WACC, which is discount rate, weighted average cost of capital. And I could explain what this means too, but it's going to be another half-hour lecture and confuse things more. So the discount rate for this company is between 7.8% and 8.8%. So that's what I wrote down here. I used a higher one. The higher the discount rate, the more conservative your estimate is. And I'll show you. Because I used the 8.8, right? So for year one, we expect this company to generate $775 million of free cash flow. So I took that number and I divided it by 1.1 plus 8.8%, which is 1.088 to the first power. So $775 million 1 year from now is equivalent to $712 million today, because we want to know what the value of the company is in today's dollars, because that's what we're doing. We're valuing the stock as of today. And the forecast for year two is they would generate $846 million of revenue. So we have to discount that by 1 plus 8.8% to the second power, because it's 2 years out. And you'll see the as the discount rates get higher, your present value gets lower. So $846 million. For this particular example, $846 million in 2 years is equivalent to $715 million today. So if you gave this company $715 million today, based on how they run their business, they should grow that to $846 million in 2 years, because they're growing at these rates. The way that's their discount rate. Every company has a different discount rate. Is this as boring as I'm doing it? Because I'm trying to explain it simply, and it's a very when I don't get any feedback, I sometimes get concerned. No one's listening to me. Now, the third year on Simply Wall Street, as we saw, so this is Simply Wall Street. So based on these 4 analyst projections, this company will generate $1.154 billion of free cash flow 3 years from now, by 2026. So that's what I put into the model. I want 12% return, not whack. We could talk about that, but you can put any return you want, but when you value a company, you should value them based on how that particular company grows. You shouldn't, like, for instance, if you were valuing Apple and then you were evaluating AMC, you're not going to always use the same exact whack, because when you're valuing Apple, there's a lot less risk involved. So you don't want to use a really high discount rate, because you're kind of shooting yourself in the foot and not giving yourself an opportunity to invest in them. You want to invest in an appropriate rate. This is not a bond. If you're investing in a bond, I can understand you're choosing your rates, but you can do whatever you want, really. It has no effect on anybody else. If you want to use a 30% whack, you can use it. But if you want to value a company and understand how much that company's worth, you should value that company based off of how how they allocate their capital, and based off of how they grow, not based off of what you feel your minimum is. If that makes sense. But I get why people say I always do a 10% whack. I understand why, but I don't think that's a good way to do it. Because if you think about it, what the fuck? Come on already. If 2 friends wanted to borrow money, come on. Friend A and friend B. And fucking so annoying. And friend A and friend B each wanted to borrow money. and they wanted to borrow $10,000. And you say that I need a 10% return because I'm not going to lend money out to anybody unless I get 10%. Because the market, I could probably make 10% in the market. I could get 6% in the money market fund. So you say, and friend A is like, no problem. In fact, I'll give you 11,500 just to make you feel comfortable. Even more. And friend B says, 10% is a bit steep, but fine. I'll give you your $11,000 in 1 year. So what would you do? Well, you have this whole notion where I have to get my 10% return, right? So you would of course pick friend A because he's willing to even go above 11,000. He's saying, I'll give you 11,500 because I really need the money bad. But if you do a little background on friend A and B, you find out some more information. You find out friend A, who's going to give you an extra 500 because he really needs the $10,000. You find out he has $250K in debt to your other friends. He's unemployed, so he's not even bringing in any money. He has $1,000 in the bank. And then when you do a little more research into friend B, you find out he doesn't owe anybody money. He has no debt to anybody. He makes $90K at his job. And he has $30K in the bank. So when you do this kind of due diligence, who would you now rather lend to? Obviously friend B, right? It's so much less risk. So when you give everybody the same exact discount rate, it doesn't make any sense because friend A should have gotten a discount rate of like 20%. And friend B should have gotten a discount rate of like 7%. Then you're just going to be losing a lot of money by giving it away to companies that will never provide you a sufficient return. It's just too much risk out there. Does that make sense? Where the 7% is almost a guarantee payback because he doesn't have any debt. He has a good job. He has a lot in the bank. He just needs a 10K because for whatever reason, he has to wait for his next paycheck or whatever. So the discount rate is just one part of it. You have to look at the risk involved. So you don't want to apply the same exact discount rate to everything because then you would be giving all this money away to people who can't afford to pay it back, thinking you're going to get a 10% return when you never even get any return because they don't pay you back. And then these really good investments, like your good friend who always pays back people, you get your guaranteed 7% return, plus you get your principal back. Okay, so anyways, so that's how I get the basic per year. I do I take the WACC. And the WACC is tied to that company. Every company has a different discount rate. Some companies have higher or lower discount rates. You might see a company with like a 20% discount rate because they're just extremely risky. So that's how you get the future cash flows. That's how you get the present value of those 3 years. And you could go as many years out as you want. You can estimate for 50 years, or you can estimate 1 year. But you just have to, at some point, do a terminal value, which takes into account all years beyond, in this case, year 3. So it's all future cash flows from year 4 and beyond. If you estimated 6 years of cash flows, then it would be 7 years and beyond. So how do you get the discount rate for to get the cash flows before you discount them, you okay. So terminal value, you could just Google terminal value. Same thing as the dividend discount model. So to get what the future cash flows will be before you discount, you take the last free cash flow, which would, in this case, it'd be this year 3, 1.1 billion, times 1 plus the terminal value. So this is I project they're going to grow at a 1% rate in perpetuity. A lot of times I use 2.5. What happened? A lot of times I use 2.5, especially for bigger companies. But this is a Chinese company, so I'm giving them a lower terminal value. But I usually don't want to go above 2.5. Something's wrong with the stream? Are you not hearing me? I got my tax filings. Delta Dental. Okay. Okay. So I hope that okay. So to calculate the terminal value, you first have to calculate the free cash flows before you discount them. So you take the last estimate, free cash flow estimate, that's 1.1 billion, times 1 plus the terminal value. And that's usually like 1%, 2%. Over, I should have put, F9. Let me just fix this. on. I thought it was already, okay. C95. Let me fix these formulas. So the WACC. Okay. It'd be good if I had this all set up already, but of course. Okay. 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 So to calculate the terminal value, you take the last year's free cash flow, whatever you estimated last, times 1 plus the terminal value, divided by F9, which is the WACC, minus the terminal value. So that's how you get your free cash flows in perpetuity. So it doesn't seem like a lot because that's forever. But once you go beyond like 10, 15 years, it gets a lot, and you discount those. I could show you what happens if you go out to like 100 years. Because even if you have like 50 billion of revenue in 100 years, 50 billion free cash flows, but when you discount it, it's so low, so it doesn't really move it much. And then you use the same, you generally use the same discount rate in the last year. 1.0. So you just use the same discount rate in the past year. Yeah, that's it. So your free cash flows on a nominal basis without any discounting is 21.5 billion. But that's future free cash flows. That's if you ran the business in perpetuity, you get 21.6 billion. But you need to discount those numbers back to today's dollars. So you take year one divided by 1.088, you get 712 million. You discount year two, year three, and terminal value. So the sum of these is what your company's worth in today's dollars, 17 billion. And you divide that by 166 million shares, and you get your calculated stock price. Come on. But I have this model on Patreon. So if you go to Patreon, even if you do 1 month on Patreon, $5, you can get the model. But this is just any type of discounting. This is kind of like the process. Now, the complex thing is, I mean, it's just math, right? Simple formulas. The complex thing is like, are these future free cash flow numbers, I got it from this website. I mean, are they correct? I mean, no one really knows, but like, if you have a good feeling about this company, you may feel like, I think by 2026, they'll be at like 1.5 billion. So then you could kind of like you could increase this. Wow, I got to 1.5. Just I didn't put 1.5. I just multiplied that by 1.3. Isn't that funny? And so you could increase this number, and that would increase the value of your company to 21 billion, 130 a share. Or maybe you feel the WACC is too high. The range is 7.8 to 8.8. You feel it's probably 7.8. So watch, it's going to go up. The stock price is going to go from like 102 to like 115 or 122. It's going to go up because the lower the discount rate, the higher the valuation. Same thing with terminal value. So you have judgment to massage these numbers: the terminal value, the WACC, the future cash flows. I mean, you can't really change like the current stock price because that's kind of set in stone. You can't really change the shares outstanding, even though the shares will change in the future, but you're basing your valuation on today's shares. So you have to use kind of today's. But you have carte blanche to change these numbers to however you like, especially if you have a really but it's good to, when you do look at these models, the way you really understand them is when you start moving numbers around and things kind of fall apart, like they break, and you got to figure it out. Like, why did like say you want to do 8 as your WACC, but you put 80 in without even thinking about it, and you'd be like, what the hell? How could it go from, it was just $122 a share, now it's $8 a share, and I just moved the WACC up a little bit. And then you could spend hours trying to figure it out, and then you realize, oh, I put 80%, not 8%. Or you can estimate, you could go further out into the future. And if you have your own company, it would be so much easier to make these kind of changes, because then you have more insight in your mind. You'd be like, well, I kind of know that I kind of know rent will probably be a lot higher next year, or maybe in your mind you know there's going to be some big expense coming up like insurance, or I don't know. So you might have more insight into this stuff. So it's good to kind of like play around with this stuff, and you learn it pretty well. But it's all guesswork. Like Warren Buffett says, he generally buys a stock when it's a screaming buy, and he doesn't buy it when it's an obvious sell. So if a stock looks really undervalued, like in this case, it's not a screaming buy. It looks like a buy. But if it was like, we did the numbers and we're like, this stock should be worth $500 a share, not $80 a share, that would be something like he would probably buy or think more about. Okay, so any questions? We kind of beat that horse to death. I mean, is this stuff helpful, or is it kind of like a lot of kind of minutia? I mean, it's good for me because I know this stuff, but it's good for me to explain it and reinforce it in my mind. But when I do these DCFs, now you can maybe have more of a input into the process. You can be like, wait a minute, why are we using such a high discount rate? Or why is that terminal value so low? Tall, check tall, please, tall. But terminal value is just is the same as the dividend discount model. The Gordon growth model, and dividend discount model, that's pretty much what the terminal value is. Well, like if you looked at Meta is paying what? It's a $2 quarterly dividend. So maybe Meta is not the best. Let's do like AT&T. You want to look for a company that pays a significant portion of their earnings out as dividends. So quarterly dividend. And we can use the terminal value or the dividend discount model, whatever you want to call it, $1.11. It's just a different way to value a company. And a dividend discount model assumes the company pays all of its extra funds out as dividends. It doesn't retain any money to grow the business. So the formula is P sub 0 equals D sub 1 over K minus G. So P sub 0 is the theoretical value of the stock using the Gordon growth model or dividend discount model. So D is the dividend. So it's a quarterly dividend. So we have to annualize it. Okay, so annual dividend. Yeah. Thanks, Yacero. Just getting some feedbacks it has helpful. It makes me feel like I'm not just talking to myself. And then so we know the dividend, it's given to us. Of course, the dividend can change. We can't control that. But we have to use the information we have. Now, K is the market discount rate. And G is the dividend growth rate. So this is how you calculate the value of a stock using the dividend discount model. So what's a good market discount rate? What is a good... with all this stuff, there's a lot of kind of like, it's very arbitrary. You might use a different, 7% discount rate, the investment rate, while 3% is the rate I tend to see. It only holds a slight edge over the 7% discount rate, which is based on the average long-term rate. So let's see if we can do a 3% to 10%. 3% is kind of low. And then the dividend discount rate. Let's do 5%. That's pretty low, 3%. Let's pretend their dividend grows 3% a year. So now let's just plug it in. So D1 is the annual dividend. Over K minus G. What am I looking for? Okay. It's trading at, am I not supposed to annualize it? Is going to be a method used for predicting stock price. The estimated value of next year's dividend. Yeah, I think K minus G. Okay. Okay, so this is what?
To make tax? Quarter 4.
Yeah, I think 4. Yeah, 4. So you see, this is not a perfect solution because obviously AT&T doesn't pay 100% of its earnings and dividends. A REIT may make sense more for this, but let's just see. So AT&T, $1.11 in dividends. That's for the quarter, right? It seems too high because $1.11. That's the annual dividend. That's why. I'm wondering why it's so screwed up. Because that's the annual dividend. I multiply it by 4. I thought that was a quarterly dividend. Okay, so this makes sense. Okay. Okay. So if they're paying $1.11, then you have to discount it by the by K minus G, the market discount rate minus the dividend growth. So if we assume the market discount rate is 10%, meaning I guess the market grows at a 10% clip a year, and T pays a 2%, a dividend that grows 2% a year, which is low. If you want to raise the 3%, then it's up to $16. But maybe the market discount rate is on the higher side. Maybe bring it down to 7. So it's very arbitrary on what you plug in. What is discount rate? The market discount rate also required yield or required return is the rate of return required by investors on the risk of the investment. Place. Remember the discount rate was like nearly 0 for a few years, and now it's up to like 5%. So P, that's 6%. So it's between like, well, 0 is kind of low. Let's go to between 1 and 6% as the market discount rate. So if the market discount rate is 1%, then actually this is that's the thing. If the market discount rate is below the growth rate, you can't do this, because then it gives you a negative number. So the market discount rate has to be above. So that's a flaw in this calculation. I don't know if anybody's familiar with this flaw, but let's just say the market discount rate is 2.5%. and the dividend growth is 2%. So the value of the stock is $222, which obviously is crazy. That's why when market rates were rock bottom, it was kind of like we were giving away money. You could get loans for like, my home loan was 2.5%. Like it was like you were giving money, they were giving money away. So it kind of like threw everything off whack, off balance. Let's just pretend it's around a 3% discount rate. But the problem is G can't be higher. The growth can't be higher than the discount rate. The same flow exists in the denominator of terminal value. Yeah, exactly. Does anybody know why your growth, why can't the growth be higher than the discount rate? Does anybody know why? Because if you think about it, the market discount rate is like how much the market grows, like the growth rate for the entire market, in a sense. So if in this example, if the market is growing at a 3% rate per year in perpetuity, because this formula is in perpetuity, and AT&T is growing at a 4% dividend, then it implies AT&T at one point will be larger than the entire market if it's growing at a faster rate. So that's why you can't do it. It's negative. It doesn't make sense. That's why when you do a terminal value, you can't have like a 6% terminal value, because at some point, the market as a whole doesn't grow that much. And we're not talking about the stock market. doesn't grow that much. We're talking about the economy, the U.S. economy. So the discount rate is based off of the U.S. economy. That's why these rates are so low. Like, it's never above 6%, because these are like the risk-free rates given by the Fed. So it was like a decade of like close to zero. Then it came up. Then it went down to like negative at one point. So if you keep it at 4, and then AT&T grows at a 2%, because if it did stay at a 1%, say it stayed at 1% forever, like in Japan, they have negative rates. Then that means that if there's a company, like if the discount rate, the Fed offered 1% to everybody, and there was a company that paid 2% dividend, it grew forever, then do you understand that that company would be bigger than the entire U.S. economy at some point if it's growing faster, which can happen. So that's why it's really an art, not a science. It's very subjective in terms of the inputs. But this dividend discount model, you could probably use it for REITs or MLPs, because they pay most of their earnings out as dividends. So they and that's where it works the best. Because if you like use this for a company like Microsoft, this doesn't make sense, because Microsoft only pays out a small percent of the earnings in dividends. BCE, I don't read too much into market discount rate, but I see where you're coming from. Yeah, because like it's like in Japan, they've been at negative. They've been in deflation. They've been at negative. The discount rates on. Oh shit! The company's here. My friends are here. Well, thanks for the stream. I think it was interesting. We went through a lot. Enjoy the Super Bowl. And I'll talk to everybody soon.